Good morning, everyone. My name is David Scherer. I'm co-CEO of Origin Investments, and I'm here with my colleague, longtime colleague, Tom Briney, who I'll introduce in a moment. The title of this webinar is The Best Cities to Invest in Post-COVID, and we'll go into deep detail about why in a moment. I just wanted to first start the webinar talking a little bit about Origin and why we're equipped to have this webinar. Origin's been around for 12 years. We focus in multifamily nationally with a focus on the Southeast, the Sun Belt, Texas, and Denver. We currently have 5,000 units that we own and operate, and we have another 1,000 units that are in development. Historically, we've invested over $2 billion into real estate across 5 funds. Our first and second funds were rated top decile. They both had an IRR of above 20% for our investment partners. And our fourth and fifth funds are currently open-ended funds. We have a qualified opportunity zone fund with a multifamily focus that has 200 million of assets currently. We also have an income plus fund with 200 million of assets as well. Both are still raising capital on a daily and monthly basis. And so we have a lot of real-time data and historical data to share. I'm going to introduce Tom now. Tom Briney, my colleague and friend for 9.5 years at Origin. It flies. Tom, prior to Origin, he was at Equity Office for 5 years. And currently, Tom is our Director of Acquisitions. He runs our Western operations out of his office in Denver. Our model at Origin is all of our acquisition officers live in their cities. We believe that leads to better relationships, better connectivity, better deal flow. And we pair that with our own AI and data systems that we house in Chicago. Tom, this year, in a year that's been a very weird year, Q2 essentially never happened, has still sourced over $200 million of new real estate. Most recently, he sourced a deal in Colorado that we can't really talk in detail about. I'll leave that up to him because it's still in due diligence and we're still working out the operating agreement with our partner. A little story about Tom. He was a football player in college briefly at University of Connecticut, and he had a few concussions and decided to hang up that sport. So he picked up downhill skiing and he became captain of the Yukon skiing team. And then when he was done with that, he entered competitive cycling. And I'll embarrass him a little bit. I believe he was maybe one notch below Olympic level in the dome cycling. What's the word for that, Tom? Where you chase each other around? Velodrome?
Velodrome, yes.
Yeah. So, I think that everything he does pretty hard and fast, and I like that about him. So, Tom, let's jump right in. Did I get most of that right on the introduction?
You did. Thank you for the embarrassment. It is accurate, and I'm happy to be joining you today, Dave.
Well, great. I think that first we should talk a little bit, Tom, about because this is talking about the COVID effects and the reevaluation of real estate, and we'll go into detail there, but why don't you start with how Origin selects markets, because these are long-term decisions for us, and we have to get them right, because then our people move to the markets and we develop relationships and data, and we like to know building by building everything in a market, so we don't get to move around markets readily. It takes years and years to develop what we have. So take us through the process of selection.
Yeah, and in market selection really does matter. And that's what you can see on this chart here is our markets relative to the standard US growth versus the gateway cities. And you can see that the markets that we've selected very intentionally are outperforming just about every single year the US average and the coastal market average from a rent growth perspective, which in return becomes income at the property level, as well as cap rate compression, meaning the value of incremental dollars that you generate at the property level is being created into value for the property even more quickly. The point being, market selection matters, and the process through which we have done that historically has evolved. When I first joined in 2011, we didn't have very specific markets. If you remember, we were in New Hampshire one day and Seattle the next day. It was disparate, and it was, let's find the best deals that are available out there. But as we decided that we needed to create scale in our markets to really know them street by street, block by block, building by building, we wanted to focus on those individual markets which make the most sense, which give us the most tailwinds to be successful going forward. So it was probably about 2014 or 15, I think, when myself and Dave Welk put together what was a rudimentary market selection model. And what we did for that was we really brainstormed and said, what are the most important things that will make a real estate investment successful? And I think the first and most important piece is job and population growth. And then from there, if you want to flip to the next slide, we have a job growth, a job metric. It's not just job growth that matters, but what types of jobs you're getting. And so this is an example of different education levels and the unemployment rate. And you can see it's pretty obvious here that the higher the unemployment rate, the lower the education level, or said differently, the more education, the more likely you are to keep your job in a downturn. Now, this is the March recession that we're currently in. It's the same story from 2007 and 2008. And it's the same going back to 2001. The better the education, the better the jobs, the more likely you are to be recession resistant. So we took the job component very seriously in our model. And we combined that job and population growth with more than 30 different metrics. We focused on STEM job growth, quality of life, cost of living, and all of these different 35 metrics. And then we weighted them and we said, what's the most important? Obviously, job growth is important, population growth is important, but so is historical cap rate volatility, if you will. And so we took all of these 35 different metrics, we weighted them differently, and then we put the top 40 MSAs in the country into the model. And we said, where are these shaking out? Where do we want to be? And where will we have the most tailwinds for success based on these growth metrics? And that's ultimately how we selected our first 8 and then 10 and then 12 markets.
Yeah. There's so many variables, business friendly environments, another, fiscal stability is another, but all these things matter. And I would only add, once we were through selecting the cities themselves, then we did the same exercise for submarkets. Because if I said to the people listening into this webinar, this is where Chicago ranks as a city, that's an absurd statement, because Chicago is the amalgamation and summation of 25 neighborhoods that are all very, very different. And I think we can agree that what's happened in the West Loop and River North is very different than what's happened in Bronzeville, et cetera. I mean, to group Chicago into a city isn't accurate, and you can't be successful and make money doing that. Chicago is sort of an extreme example, but all cities have that same dialectic. So yes, we selected markets, but then the deal officers had to go in and do it again and say, okay, well, this is the micro analysis. And then you can actually take it further than that and say, okay, within a specific neighborhood, what are the actual block by blocks where I want to be, right? And that's where living in the markets really adds a lot of value. Would you agree, Tom?
I totally agree. I think that's 100% accurate, that really by selecting the 8, 10, 12 markets, we're in 12 markets now, by selecting those markets, that's just the starting block. Just like when you are awarded a deal from the broker, and even when you close a deal, you're really just starting at that point a 10-year journey of ownership of that asset. It's the same thing with markets. You select a market and then you move there, or I move there, or whoever the acquisition officer moves to that market and spends all of their waking time trying to get to know every single block, every single player, where you want to be and where you don't want to be, because that's just as important. I would rather be in a sub-market or micro market that is less ideal from a micro scale, but still in the right macro market, but it's still very important to be successful over the long run to be in the right micro markets and on the right streets.
So Tom, what are your favorite? I'll answer my own question in a moment, but I want you to answer it first. Um, my analysis of what's happened post-COVID, let's break down, because we were supposed to be talking about COVID and the effects on real estate and the markets. And my answer to that is all COVID has done is accelerated all the trends that were already happening. So the trends that were already happening were people were leaving New York, Chicago, California to go to warmer, more business-friendly states. And that's been happening, and it was accelerated. It was before the tax cut bill came out. But once the tax cut bill came out, now that capped your interest expense and mortgage deduction on high-end homes, which typically are in these high-cost cities. And so that accelerated a trend that was already happening. So that was your first accelerant. And now you have COVID, and number one, people are worried about dense environments, and number two, there's much more flexibility, and it's acceptable to work virtually. And so there are all these new reasons that's being accelerated again. I would only say this time, the effects are much more pronounced than they've ever been before. And so what you see, and I don't know if you can flip to the next slide, but it corroborates what I'm saying. What you see is in the public markets, there's apartment REITs that have a tremendous amount of exposure to the coast. And that was a decision they made. They wanted to be in gateway coastal cities, LA, San Fran, New York, Boston. REITs like Equity Residential, ESS, they have tremendous exposure, almost only exposure to those markets. And then you have other REITs that made decisions to say, no, we don't want to be in gateways. We want to be in the Sun Belt. We want to be in Texas. We want to be in Nashville. We want to be in Denver. We want to be in Phoenix and the Southeast. And what's happened is those public REITs that made the decision to be in the markets we're in, by the way. So Tom is talking about the selection model that he helped build, and obviously it's improved over time, but then we executed it. So where are our offices today? Nashville, Denver, and Charlotte, right? Yes, we have a Chicago hub, but all of our sourcing activities in the markets that have actually held up remarkably well because all the demographics are moving in that direction, and COVID's just an accelerant. Tom, do you want to expand on that?
Yeah, and I would like to talk about this chart a little bit as well, in that this is really an advantage that Origin has developed over the last 12 to 18 months, is this public securities focus that we've taken on. And we've created these different REIT blocks, and what it's done for myself, the other acquisition officers, Dave, and really the entire team, is it gives us a different perspective relative to what's going on today. It helps us not only corroborate what we think we're seeing, but what the market at whole is seeing. And so EQR, as Dave mentioned, has a lot of coastal exposure. CPT, Camden Property Trust, is a very similar geographic concentration to what we have at Origin. And it really gives us another lens to review everything. And that really dovetails into future decision-making as to what markets we want to focus on. This corroborates it along with the next iteration of our market selection model, which is underway right now. If there's one thing that we constantly do at Origin, it's improve the process. So the next layer of this market selection model is going to be artificial intelligence driven. And we're scraping millions of pieces of data at the macro and the micro level for all of our markets, making sure, A, that we want to be in those markets, and B, are there markets that we're not covering now that we decide over the long run that we want to be a part of and have exposure to. We added Nashville as a market probably 18 months ago, maybe, Dave, and we've been very happy with it. It takes a long time to get into a market, and we're constantly reevaluating that to make sure we're in the right markets and adding or taking away from markets that we don't believe in anymore. And really this public market perspective gives us another lens with which to make that evaluation. I would note, just adding on to the acceleration of the trends, I think you're exactly right, Dave. Not only the shift from the high cost, less business friendly states, but within our markets, the shift away from a downtown environment to a more suburban environment. It might be given away from my starting to recede hairline, but I am actually technically a millennial. And what trends I experience, which includes living downtown Chicago when I graduate college, right? Having all the party, having all the fun, working really hard, to starting a family, to moving to the suburbs. Because I'm at the very beginning of the millennial generation, I've been watching it happen for the last 5, 7, 10 years, the shift from downtown to the suburbs. COVID is really just accelerating that trend, which is already happening. Home pricing here in Denver, in the downtown markets, is relatively flat to maybe up 5%. In the suburban markets, the quality schools where you can get a yard, you're up 10 to 15% year to date. It's insane, but it's a trend that was already occurring that's just really been accelerated by COVID. People who are going to move to the burbs anyway are pulling the trigger much sooner.
Yeah. You're even seeing that in Chicago. There's been a remarkable pickup in suburban home sales. And, look, at Origin on the private side, we own both, but we're probably weighted towards suburban. But we always wanted to be in suburban infill. So Michael and I and Tom and Dave, we define infill. It's not about urban or suburban. It's about lifestyle. Right. So when you move to the suburbs, you still value walkable retail and that lifestyle. And that's where we try to position our suburban properties. But I agree with you. It's the winds are blowing to suburban. And by the way, the markets are efficient. Public for sure, private less so, but more efficient than you think. The cap rates and the pricing on suburban multifamily is stronger. And they see the same thing what we're talking about. This isn't a news flash. Would you agree, Tom?
Totally agree. The markets are really efficient. And I think that's one of the biggest shifts in real estate over the last 20 years is how efficient the markets are on the private side. And we've done a really nice job as a firm historically being ahead of those trends. And part of that is the infrastructure we put in place to make those market selections. I remember when we went into Atlanta in 2000, probably 11 and 12, when we really started focusing on that, we built up a big portfolio. We had the ability to do so because the institutions weren't there yet. They had been burned in the recession, and they had decided that they were going to pull out of Atlanta. Fast forward 5 or 7 years, and we were selling assets at prices that when we bought them, people said were absolutely ludicrous and not achievable at all. And that's part of the advantage of having a strategic market selection process, as well as being in the markets. We can see it firsthand. I often say to people, if you read it in the Wall Street Journal, you've already missed the trend. If it's in the journal, it's past you. And that's really what being in the markets has done for us, is see the trends before it makes it to the Wall Street Journal and act on those trends. And as Dave mentioned earlier, we have this opportunity to partner with a top tier developer, probably a top 1 or 2 in the country, on a development in Colorado Springs. And the reason we're so excited about that is because I've been following the trend of the Springs long before any of the publications have started talking about them. And I believe that this opportunity with this development partner is the right time to strike for our first deal in Colorado Springs, because I can see it every day, day in, day out. The people moving down there, the shift in the demographics, the lower cost of living, but you have the same lifestyle as Denver. Everything that Denver has, the Springs has, but it's a lower cost alternative. And with the work from home shift that we're seeing because of COVID, now you don't have to be in downtown Denver every day. You can come up once or twice a week, and it's only an hour and a half drive. It's the type of opportunity that we should really be striking on, because we're in our markets and because we can see the trends and because we know what's going on.
Yeah, it's interesting you say that, because so the deal he's speaking of is going into our qualified opportunity zone. And that'll actually be the largest deal Origin's ever done. It's a $100 million deal. There's 2 other deals. There's actually 4 other deals, but I'll speak to the first 2. They're in our Income Plus fund. They're will be going into our Income Plus fund, and these are preferred equity deals. But it's interesting because it's the same idea. These are in Greenville, South Carolina. So Greenville, South Carolina is in the greater Charlotte MSA, if you will. And the same thing you're talking about, Tom, with people who might want to, go to work in Charlotte once or twice a week or whatever. I mean, but they want to live in a cool, cute downtown. But Greenville is 300,000. It's not a million. But you know what? Great lifestyle, cheaper standard of living, et cetera. These are the cities that First of all, we're big believers in Charlotte. I'm not saying we're not. Charlotte's going to benefit from the exodus from New York City, and is. People are leaving New York, and that's a low-cost alternative with great weather and a great lifestyle and a lot of the city amenities they're looking for. Greenville is even smaller, but it's not that small. And you could live in Greenville and easily interface with Charlotte, and I think it's going to benefit too.
100%. It's really interesting when you stretch that even further. My sister is a prime example. She's considering leaving suburban Chicago for a town that's about 5 hours away in Missouri, and she wants a lower cost of living, a lower tax base, better school system. And if she needs to be up in Chicago for her job once or twice a week, she'll do that, and she'll drive up and she'll stay with family. And the work from home component, although I'm not ready to commit that office is dead because of work from home, it's real and it's here to stay, and it will affect the market selection going forward.
Yeah, and I'll tell a story about a deal in Nashville that we may get this deal, we may not. I'm not sure, but it's an interesting story, and it's about relationships. So when we decided to invest in Nashville, when I mean invest origin capital on people, offices, and time to understand Nashville and build relationships and build a real deal pipeline and build real expertise. And that was about, I'm going to say 18 to 24 months ago. And so I was down with Kyle, the team member who now covers Nashville and lives in Nashville. And we were meeting with a local developer. And they had a QOZ deal that we were interested in, and they had a market rate deal. And we sat down with them, and they struck me as a firm that we would want to have a relationship with. And they had been in business 20 years. They were viable. They were a viable partner. We were vetting them as an entity, as a business concern. But they also struck me as someone that wanted to take it to the next level and grow faster. And they were looking for partners, that were able to help in that way. And importantly, bring real knowledge and sophistication. I mean, one of the advantages Origin has is, since we're developing and owning all over the country, we can adopt best practices from all over the country, and then we can share them with other regions, developers, et cetera. It's kind of like the McKinsey effect. Like, if anyone is familiar with McKinsey Consulting or any of the consultants, they benefit from being at the nexus of all these very smart people at all these corporations, right? So they're actually the big beneficiary, and more than anything else, they're just sort of sharing information across networks, and in a very real way, we do that. But anyway, I'm talking to their principals, and I said to them, how can we help you? And they sort of perked up, and they said, well, no one's ever asked us that. And I said, yeah, but I'm asking you that because if we want to be good partners, we have to bring value to you. What are the areas we can help you? And we actually didn't wind up doing the one deal. It was a non-QOZ deal. The construction budget became much more expensive than we thought, so we didn't do the deal. The QOZ deal, the construction budget, same thing. It wound up being higher than what we were willing to undertake a common equity investment. But we're almost 2 years later now, and we're looking at that second QOZ deal as a pref equity investment for our Income Plus fund, but also for them, right? So 2 years ago, none of us would have thought we were talking about a COVID development. I mean, who saw any of this happening? But we've moved across the capital structure. We've continued to build a relationship. We understand the real estate because we've been looking at it for 2 years. And it might wind up being, as we sit today, we have a term sheet out, and importantly, we are helping them. We're bringing something to the table. We're adding value. Like that's how you build a business anywhere, but we're no different.
Yeah, and I would add to it that is really the advantage of being in the markets, right? With Kyle, in this instance, having the opportunity to constantly reevaluate and meet with those people. I was at a coffee shop the other day and I ran into a guy that I hadn't talked to a couple months, but that's because I was in my market. And he said, "Hey, I've got 2 deals for you to look at," and he sent them over, right? It's if you don't live in your market, you're just trying to fly in and fly out. You know, sometimes I fly into a market and fly out the same day, and you don't get that interaction, those chance happenings where you run into people, and it hurts your deal flow. And whether or not we do these 2 deals that this contact gave to me is irrelevant. The point is, the more deals you see, the more likely you are to find really good deals. And that's our
Yeah.
job, is to find really good deals.
And where the rubber meets the road, because we talked about efficiency in the private market, it's not nearly as efficient as the public markets. And the way to truly find inefficiencies is to find off-market deals. And historically, 50% of our deals have been off market, and that's our job. Our job is to try to pry away deals before they get out to 100 people, because that's when you get the best pricing, the best structures, the best opportunities. So Tom, I'm gonna put you on the spot. And before I do, we only have one live question. We did have 5 emailed in prior. So if you have a live question, we're gonna spend the last 25 minutes on questions. So just hit your Q&A button at the bottom. But before we do questions, I'm gonna put you on the spot. So we're in 12 markets, as you mentioned. What are your top 3 and what are your bottom 3 in the post-COVID world, and why?
Top 3 markets for me are probably, I think Phoenix is probably the most underrated market, that maybe not just that we cover, but probably one of the most underrated markets in the country. And the reason I say that is there's so much stigma from Phoenix from the 2005 and 7 home building buildup that is sticking with a lot of institutional and non-institutional investors, that they're disregarding the market. Now, what's really interesting to me, a couple of statistics on Phoenix. When 2007 hit, they had 550,000 people employed by the construction industry in Phoenix. Today, they have just under 130,000, meaning that more than 400,000 construction jobs have left the market. With that comes a giant diversification of the Phoenix economy. It's not a construction-only economy. It's not a snowbird-only economy anymore. And the way that it's shifting is because Arizona State is a big, big driver in that. Not only are they the largest institution in the country from an education perspective, but they've set up a program that basically the president of ASU has said to the Fortune 500 corporate universe, tell us what you want from a college graduate. Once we know what you want, we can create a program specifically that will cater to what your needs are. And then you take those graduates and put them into your corporations. And it's really a symbiotic relationship. And in exchange for us creating a program for you, we want you to locate either a regional or a national headquarters in Phoenix. And so what that does is it draws national talent from around the country and around the world to ASU that then stays in the Phoenix metro post-graduation, because they've set up a structure that allows for growth of high quality college educated jobs. And so back to the very beginning, it's not just jobs, but what type of jobs are being created. Phoenix has done an amazing job with creating the right type of jobs. They've diversified away from the construction industry that has historically been kind of their Achilles heel, and are working to create an economy that, in my opinion, is going to be strong for decades to come. I think Phoenix has a phenomenal runway ahead of it. I would say my next, probably most desired market is probably Austin. It's a difficult market to buy in, but if you take any 20-year period from Austin's history, from the day the first guy slept there overnight through today, any 20-year period, the population will have doubled. And you've got, back to the first point of population and job growth, when your population doubles every 20 years, you're going to do well in real estate. And then you add into that Google and Yelp and Facebook and all the technology companies that are in Austin, you've got the right type of jobs that are being created there. Now, all of these markets have their own issues, but those are really strong fundamentals for growth in those markets. And I would add to My third selection, the easy one for me to say would be Denver. I think that Denver is an amazing place to live and be, but I also acknowledge that it's very expensive to live in, and that's a real challenge for Denver going forward. So rather than use Denver as number 3, I'm going to actually go over to Raleigh Durham and select that because they've got very similar population and job growth as the first two. They've got a mechanism in place to attract the right type of jobs, the right type of population. And I think that they'll be successful over time. Plus, in a COVID era, I don't know how the work from home lasts in the long term. My crystal ball isn't perfectly crystal clear, but I do know that the Raleigh-Durham market has a really nice blend of suburban feeling living environments as well as urban living feeling environments. So I think that it's got a lot of optionality to go either direction from a successful standpoint of where do people want to live in 3, 5, 10, 20 years from now. It's a really diversified living environment and job environment that I think really has an opportunity to succeed in either direction. The markets where I'm not thrilled about would be the coast. I wouldn't have interest in investing in the coast. Not only are you buying a very low cap rate, so oftentimes sub 4, but you've got really negative job and population growth driven by COVID, but as Dave mentioned earlier, was out of the way already. So I'm going to incorporate all coasts with that market, specifically California and New York. I would argue against Chicago, which I know is where we're headquartered and we've invested historically, but I think that we've been very selective with our investments and we're not active in moving forward in investments in Chicago in the near term because there's so much political ill will. There's so much challenge with the environment, not just in building, but in acquiring and in maintaining and the taxes. It's just a really difficult environment to be successful. And then you don't have population and job growth that we need to be successful in the real estate world. And the last market that I would use from a negative standpoint, which is one that we talk about a lot, if I have to choose, it would be Houston, I think. It's a market that is volatile. It hasn't done as good of a job as a Phoenix or Dallas or an Austin at diversifying economy. It's still, although it has diversified to some degree from oil, it still has a huge exposure to that. And we've seen it. And I think that's part of why Camden, which we showed the chart earlier, although it has outperformed EQR, its largest holdings are in Houston. And I think it's underperforming as a result of that. So those are my 6 markets. I cheated a little bit on the coast, but I'll leave it there.
Yeah, when you were talking about Austin, the other thing we have the benefit of is we've been investing in these cities for 12 years. And so we obviously have our own experiences. And I can tell you that everything we've done in Austin has done incredibly well at Origin. And it continues to. So for example, the industrial that we owned at Bergstrom Airport, that was one of the highest cash flowing, highest IRR, multiple deals, certainly top 5 that we've done. Currently we own in East Austin, and that particular asset is performing very well, and it's being buoyed by Tesla's announcement that they're going to locate their new corporate headquarters, and they're going to be moving tremendous amounts of jobs to the area. So there's also the personal aspect, like as you own, you get that data and you start to think, well, you're right. It's hard to buy in Austin. It's hard to buy in Nashville. It's hard to buy in Denver. But it's our job to try to get an edge. And when it's hard to buy, it's usually for a reason. It's because these are assets you want to own long term. Anyway, Tom, we're going to move to questions because now we have 17. So these are all live. I had to move my location because I had a tech issue, so I'm doing this from my phone, and our techs are now at my office, which is kind of funny. But I can't do the emailed questions because I don't have a computer in front of me right now. Why don't I start with the live, and then you can, while we're doing that, drive the pre-asked questions. Make sense?
Perfect.
This is what live TV is like, by the way.
This is what it's all about.
Okay, so first question, and I'm not screening, so I will either answer it myself or ask you. So first question, the answer is yes. We'll send you the copy of the charts. That's fine. Anyone who's on the webinar will follow up by sending, assuming we have your emails, we'll send you the deck. So that was easy. Second question, how do I get information on the Colorado Springs development? And Tom, you can answer this, but it's not actionable unless you're an investor in our QOZ fund. You can't invest in a deal. We don't do deals, but you can expand on that. Go ahead.
Yeah, from a timing perspective, we're a couple weeks early before we're going to really release all the details of that particular deal. We're deep in our due diligence right now. It's looking very promising. I have all the confidence in the world that it will be a deal that we execute on, but we're not quite able to share all the details on it yet. That'll come out in the next, I would guess, week or two. But as Dave mentioned, in order to get exposure to that, you need to be in our Opportunity Zone fund. That's where the investment will occur. And then if there are other questions on the other assets within the Opportunity Zone fund, we have a phenomenal investor relations team that can answer those, or myself or Dave or any acquisition officers who source those deals are happy to answer those questions as well.
Yeah, and this is a conversation for a different webinar, but the Colorado Springs deal, if you've been in Fund 1 or Fund 2 or Fund 3, we did a deal called Chamblee, which became a deal called the Olmsted when it was developed. And this deal reminds me an awful lot of that deal. Both are in great locations. This is probably a better location than Chamblee, and both have very large tax incentives where you're not paying much taxes or any taxes for 10 to 15 years. So the margin's extraordinarily high for that reason. However, we don't do deal by deal capital raising at Origin. We're a fund manager, and the reason for that is, as much as I believe in Colorado Springs, and I do, it's one deal. And we believe that you should have a portfolio of investments, because with a portfolio, you get the power of the portfolio, and we believe that we're good at what we do. And if you're in 10 or 15 deals, then statistically, you're going to do very well. If you're in one deal, you could do very well, but if there's a hiccup, you might make a 10 or a 12 or a 14% and wind up disappointed in the deal. The next question, what databases or platforms are you using to source data? Tom, I'll give that to you. This is probably, make it a question more about AI and talk a little bit about our AI platform and what we're doing.
Sure. So the answer for the AI platform is a lot. We've built in our building an AI platform that will help us with not just the macro selection, but the micro selection, the neighborhood by neighborhood selection of the markets that we want to be in. And it's a combination of scraping for everything from municipalities and their the permit data that is public record, to job data, to walk scores, bike scores. There's more than 50 different data points that we're actively live scraping from a host of different sources for our AI platform. And that's, some of them are municipalities, some of them are paid resources like Radix and Yardi, where we have the information available because we are a paid subscriber to these resources, and we can then pull them into our system and understand what the micro trends are happening. And we use those data sets to really compare against and work with the gut of the acquisition officer. So I've been doing deals for 15 years. Dave Welk has been doing deals for 15 years. Kyle's got a long track record of doing deals. And there's a lot of things that you see as an acquisition officer that you just know is a good or not good deal based on the years of experience of doing deals. And so we've been triangulating through AI deals that have been successful to us, deals that we didn't do but maybe should have, and vice versa, deals that we didn't do and we were glad we didn't do, and trying to triangulate what we didn't like about those deals or did like about those deals with what the data is saying. And so this AI platform combines all of that knowledge to help us make better decisions going forward. And the answer of what resources do we use, it's literally 50 different resources. In different markets, it's different resources. So what data might be available publicly in Denver might not be available publicly in Orlando, as an example. And so we have to find different resources. So it's really a proprietary amalgamation of different data points.
All right, thanks, Tom. Next question. Given that 50% of your deal flow comes off market, how many of those deals would you say are from recurring relationships? That would seem to measure that you're leaving some meat on the bone for those off-market partners as well. Okay, so I would answer this question. It's different in a distressed economy or normalized economy. So in the years, 2010 to 2012, which were distressed, those were almost exclusively one-off deals. So we were doing them off market, but it was one-off. And the reason was we were buying out of bankruptcy, or we were buying a note from a bank and then foreclosing out the owner, or we were restructuring a note, or we were doing a deed in lieu. And in those situations, we have relationships with the ecosystem, but the actual deals were one-off. The deals in the normalized economy are much more deals that happen at least 2 or 3 times. And so in an off-market transaction, for example, Tom, the value add deal that you sourced in Denver in 2017, does that sound right?
Yeah, sourced in 17, closed in 18, that's right, yeah.
That same connectivity or that same source came to us off market with the deal that's in our Income Plus fund. And this again, it was a seller who didn't want to run a public process, and maybe they understood that would result in a slightly lower price or not. I'm not sure, but it did, and we wound up, we believe, buying the asset probably 3 to 5% below what was available if it was broadly marketed. And I'm not suggesting, by the way, that we buy off market and therefore we get a 30% discount. Anyone that tells you that isn't honest. That's not true. But if we can nick off that last 2, 3, 4, 5%, that's our job. And that's what I'm confident we do. Next question. How do you underwrite political risk? For example, how are you dealing with the significant property tax increases in Nashville for projects currently in the pipeline? Tom, you can answer that, or I can, specifically the Nashville issue.
Go ahead, Dave. I'll let you chime in on
that. The answer is it's our job to constantly be evaluating political risk, and we do. And so it's part of our underwriting and deals. So like, let's make it tangible. Nashville, the property tax increases there have been widely understood as a risk for the last 2 years. And so as they've become not just a discussion, but now they're actually happening, we had been underwriting those higher taxes in all of our models for the last 2 years. And because you can't be wrong on that. Your NOI goes down too much. And so what that really meant was it was incredibly hard for us to ever make a model work, because some of our competitors weren't. They were pricing in existing taxes as if they were going to continue. But that's the answer on Nashville, is we've been pricing in those higher taxes for quite some time. Next question. What is your take on the single family rental segment, build to rent or otherwise? This is definitely for you, Tom, because you've been all over this for about 3 years.
I am a huge fan of the build for rent, and I think it's only going to be exacerbated by COVID. I have tried ad nauseum to get as much exposure as possible for Origin. I've chased the same portfolio of thousands of assets twice. I'm a huge fan. I think that when you can say, and it was interesting, I had this conversation last night. I was out for drinks with a colleague here in Denver, and we were talking about the build for rent story, and that some, especially even Freddie and Fannie, aren't interested in lending on it yet, and some of the life cos are just trying to get on board now. And it's a newer product type in that you don't have 3 or 5 or 20 units stacked on top of each other. It's just a single story rental asset. And so for whatever reason, there's a hurdle there for some of these senior lenders. All I have to do to convince somebody to invest in a single for rent home, if you will, is to walk into a traditional apartment complex and stay on the first floor, and I'll go upstairs and I'll stomp around, or I'll bring my kids up there and play baseball and break some things, it becomes very obvious how much better a single family rental environment is than a traditional 3-story, 5-story, 20-story apartment complex. Now, it's not for everybody, and the challenge with them is because you need a lot more space, you can't build them in an infill or even a moderately dense suburban environment, but you can build them in a path of growth. And at some point, where you're building today, that is maybe the edge of the current acceptable environment for where people want to live, at some point that will be the middle of a dense environment. And so I think you've got a really high quality product for the people who are looking for that type of product in an area that will be, through path of growth, an infill feel over time. I'm a huge proponent of the product type.
Yeah, the key is you have to select cities that are growing, right? Because in non-growth cities, the growth doesn't happen, and then but the portfolio we were looking at was in Phoenix, and it was a large portfolio. We actually chased it twice. Once was pref and once was common. We didn't get it either time. I mean, we're very disciplined about what we'll structure, what we'll pay. But Phoenix is obviously a high growth market, and that's one of the reasons we liked it. Okay, next question. Do you foresee a shift back to urban driven by Gen Z and young millennials? I actually do. I think that the pandemic is going to end. And I'm not, this isn't my area of expertise, but I'm reading that they think a vaccine will be out certainly by December and available to the public maybe by next summer. That's what I'm assuming at this point. Yeah, I do. And I also believe that, when we were talking about the stocks earlier, equity residential, for example, that's a great stock and they own great assets. And yeah, they're on the coast. And right now, no one likes that. But you know what? You can also buy that stock at 2015 pricing right now. And I'm a buyer. I think it needs to be part of your real estate portfolio. So we're actually accumulating positions in some of these coastal cities for the Income Plus Fund because we got it so right. Our entire private portfolio is in all the cities that are everywhere people want to be. And so why wouldn't we want representation in some of these other areas that are really beat up and companies that have great assets? And by the way, we haven't really talked about this. This is a conversation I had yesterday on the public webinar, but the implicit cap rates of public REITs are 100 basis points higher than what we're seeing in the private side. So there's a massive public-private dispersion on value as well. And so that's part of what I'm looking at. Next question. Go ahead, Tom.
No, I'm just going to add real quick to the idea of the shift back to the cities. I totally agree with you. I think it will happen. And just thinking about that, humans are social in general. Not everybody, but generally speaking, people like being around other people. I would say, majority of humans like to be around other humans. There is no time in your life that you are more social between high school and college is as social as you're going to get. And most folks want to continue that post-college, which is why in Chicago, Wrigleyville is so popular. And then there's a natural transition from high school to college, to that social scene post-college, to having a family. And that family, which you then move out to the burbs, it's a natural progression. It's been going on for hundreds of years since really the invention of and acceptance of the city. And I would expect it to continue. And I agree with Dave that the COVID blip out of the cities is an acceleration of the millennial generation moving out of the cities, but I don't think it's the death of a city for sure.
Next question. What consideration is placed on construction costs in different markets? And I can answer that. We underwrite each development down to the construction costs. It's sort of a dance because you have to build out CD sets enough to get accurate construction numbers. But when you're ready, when you're at 80-90% CDs, you can then go down to the subcontractor level, which you have to. And that whoever asked this question, you're right in the sense that the subcontractors and regions do have different pricing based on their own schedules, and demand for labor is a big one. What we're seeing right now is generally, nationally, construction costs have gone down, which is remarkable because just to give you a little history, construction costs were going up, anywhere from 8 to 12% a year for the last 6 years. And so the fact that they didn't even go up is interesting. And they actually went down probably 3 to 5% on average. However, we're also seeing a massive run up right now in lumber. And lumber is primarily, I believe, caused by COVID and the inability of the factories to process it. So it's just a supply demand issue. Lumber's a huge input in certain constructions like stick built construction, garden. It's your biggest input. And so that's probably going to, on average, bring construction costs back to flat from down 3 to 5. I also believe that's a short-term disruption, and it probably, if you're buying out your lumber in 6 to 8 months, it'll be quite a bit lower than where it is now. Next question, because we have a ton, and I don't have enough time to cover them all. Okay, Tom, what is your outlook for the Atlanta real estate market going forward?
I am not an expert on Atlanta, but I feel very positive about it. It's similar. It's a bigger, more tax-friendly environment than Denver. It's a cheaper cost of living. It's got all the things that we've talked about. It's got the job growth, population growth. It will benefit hugely from the shift out of Chicago and New York. Frankly, so one thing that we haven't covered is when we opened up the Southeast office in Charlotte, I actually moved there with Dave Welk back in 2015. When we were in Charlotte, and that was totally fine, but coming from Chicago, I really wanted to be in Atlanta. That was, to me, more of an urban feel that I was looking for. And then ultimately I moved to Denver to open up the West. But for me, I think Atlanta is a really nice alternative to major big cities in the North that will suffer from the lack of competitiveness, from the lack of job growth. And I'm bullish on Atlanta for the foreseeable future.
Yeah, I am too. It has everything that you want long term. It has good weather. Importantly, it has it's either second or third busiest airport in the country. It has connectivity to the highways. It has connectivity to Florida, but also the Southeast. It has lots of universities in the city to provide talent and labor. There's just an awful lot there to build on. And so I'm very bullish on Atlanta long term. Right now, however, there's a decent amount of supply that's coming. When I talk about supply, I'm talking about multifamily because that's what we focus on here. But there's a short-term supply that needs to be worked through. But candidly, that's true in a lot of the cities that we're in. I can say the same thing about Austin or Dallas at this point. Okay, next question. I think we've covered a few of these, and which is good. Okay, here's a good one. How has COVID changed your approach to underwriting deals, Tom?
My approach for underwriting deals hasn't changed because of COVID. Now, some of the decisions I make in my underwriting metrics and some of the inputs that I use, I've altered. Growth is one example. But the metrics, what I look for in a good real estate deal really starts at the market level, which hasn't changed, won't change in the near term. The micro market, which hasn't changed, won't change in the near term. And then the physical asset, and then the potential partner. Those items are, regardless of COVID, going to be things that I'm very focused on in general going forward. The actual underwriting metrics that I look for, we've gotten more conservative, certainly on our rent growth analysis, where we think rent will go. And that was really the genesis of our AI platform, was to help us more accurately, predict rent growth going forward. Because a lot of operators out there will just say that 3% forever, right? Regardless of where you are in an economic cycle. And we want to be more accurate than that. And so we've created this AI platform that has put us within $5 based on historical back testing of what happened in reality. So with that platform in place, we can be more accurate and probably in the near term conservative on our rent growth assumptions, because there are people who are buying homes now. Mortgage rates and this is not necessarily directly by COVID, but just the idea that mortgages, 30-year mortgage below 3% is unheard of, and it makes buying a home much more affordable. There will always be renters that are needed, but it's shifting the demand for a short period of time towards home buying from home renting. And that means you have to be more conservative or accurate or aware of what your rent growth is going to be in the near term. So things like that get shifted, but the fundamentals of underwriting don't change because of COVID, in my opinion.
Okay, next question. And by the way, Tom started here as our head analyst, then he moved to investment management, so building out our business plans. I think you moved into acquisitions 6 years ago. Does that sound right?
Yeah.
And at every level, he was our best analyst. He was an amazing investment management professional, and now he's unbelievably prolific at sourcing. But what he is more than anything else is he's unbelievably sound with numbers and modeling. So when he talks about what COVID does to underwriting standards, I'm not going to add to it. Okay, so I'm going to put you on the spot. Denver, what are your two favorite submarkets? Suburban submarkets in Denver, and why?
Oh man. My two favorite suburban Denver submarkets. Denver is an unbelievably difficult place to buy right now, which is why we haven't bought anything in 2 years in Denver. And the reason is you're buying above replacement cost for product that's 20 to 30 years old. There are trades out there that are 90s vintage value add deals that you're buying for $240 a door for suburban multifamily garden product. To put that in perspective, we're building product in the market as suburban like-kind product at that price. However, when you're buying 90s vintage product that you have to put another 20 a door into, you're actually paying for the opportunity to build something that's inferior to what we can build at a lesser cost. So where I'm interested in buying in Denver is not too many places. I'm very interested in building in Denver. Building in Denver, we have a project out by the airport that I'm very excited about. We broke ground on that in July of last year. We're about 70% leased now. It's performing exceptionally well, and I expect that market to continue to outperform the rest of the metro from a suburban perspective. It's got all of the creature amenities that you would want. It's got great access to the airport. It's got light rail transit to the downtown markets and to the suburban job markets. And we're building for a price that makes a lot of sense. I would expect that market to outperform over time because it's a low cost option for renters. Compared to other suburban markets, 20% potentially. The other markets that I like, if I could get into it, would be on the west side of town, whether it's Sloan's Lake or Lakewood or Englewood. Those are real barriers to entry markets, not just physical because they're physically constrained by the mountains, but there's also a lot of political resistance to new product, to gentrification over there. But they're so close to the mountains. It's so easy to get downtown. It's got the work-life balance that a lot of folks in Denver are looking for. I would really love to be on the west side of town, but it's unbelievably difficult not to buy over there, but also to build. So if I could find something in one of those west side markets, I'd be all in.
Yeah, in addition to the project he's talking about by DIA, the development, we also have a large development in Westminster where we have an $18 million preferred equity position that's going quite well. That's an income plus fund deal. And then we also have a development in Longmont, which is essentially a suburb of Boulder. And Boulder is sort of in the Denver MSA as well. It's about an hour, Tom, is that right?
To Longmont, yeah, 45 minutes to Boulder, yeah.
Yeah, so we like that a lot because it's a low cost option to Boulder, but we're building, high quality product that people can be, proud living in. So that's a Fund 3 asset. So what Tom is talking about, what's interesting is it's not esoteric. Like, he believes in development versus buying. When we can build something way nicer than what you could buy a 90s product for, why wouldn't you do that? Well, we are doing it. That's our strategy out there. That's how we're going to accumulate scale, is by building. And we typically build to a 30% margin. Like, that's what we're looking to do. I'm going to answer two questions really quick because we're over. Are we interested in Boise? Are we interested in Salt Lake? The answer is yes to both. That doesn't mean we're going to do it, but we're using our AI and our city selection model, and we're plugging in new cities, and we're looking at it hard. And we might actually drop a city or two as well. So that's something we're literally doing right now as we speak. So in the next 6 to 8 weeks, we'll be doing that. What if we decided, hypothetically, Salt Lake? Salt Lake would be a city Tom would cover. It's obviously very close to Denver. It's manageable. He could do it. But it would take a long time for us to build the expertise and the relationships that we would feel confident in actually doing deals. So if we decided to do Salt Lake, that's an investment by Origin in the next year or two before we would even start really being active in the market in terms of deals. And I think Nashville is a good litmus for that. We decided 24 months ago, and we might start doing deals now. I mean, that's how it works. I think that's it, Tom. There's a few I didn't get to, but I wanted to get to the questions that were emailed in prior. I think there were 5, and we'll do them really, really quickly.
Sure.
Do you have that?
I do. So 30 seconds or less for each answer. Are there any cities you're going to stay away from due to changing fundamentals? We touched on that.
Yes. We are not actively looking in Chicago or Houston. Next question.
How do we move forward with sourcing new deals in a city once we've identified that city as one that we want to be in?
I think we covered that already, but it's about mapping the submarkets and understanding not just the city, but where we want to focus in submarkets. Usually that winnows the city down to probably 15% of the opportunity set of the city is what we'll look at. In other words, we're saying no to 85%. And then from there, we're looking deep into the relationships and buildings that we want to target or development sites.
You're going to love this one. What are your predictions on office? 30 seconds or less. And do you see bigger corporations migrating to the suburbs from smaller satellite offices?
Yeah, I see what's happening with COVID is permanent. Not the pandemic. We'll get through that, but it's acceptable to work virtually now. And there's a lot of business owners that recognize that there's huge cost savings in not having large offices. And there's also huge time savings and actual money savings for the labor force not having to commute in or even live in high cost cities. So I don't know what the segment is, but there's a segment of demand in office space that won't come back, and it's being replaced by virtual. And even if it's small, let's say if it's a 5 or 10% segment, think about what's happened to retail. Retail is only 15% online. 85% of retail is brick and mortar. And think about the carnage and disruption that 15% has caused. So, like, in my opinion, anyone who's not seriously looking at this trend, and by the way, your new entrant into the office space, their name is Microsoft. They are competing with you. They have a product called Teams. They're going to make it better every day. And they want to put every business owner who owns buildings out of business. And they have a long history of being successful. And I'm not interested in being on the other side of that.
Last but not least, have you resumed a normal pace of investment following the Black Swan event?
We actually have. Q2 was essentially a quarter that we hunkered down. We spent an enormous amount of time on internal infrastructure, things like Project AI, things we were talking about. But Q3 has been normalized, and we've actually had a very productive quarter in finding new deals and capital raising. So it's been a strange year. We had an amazing Q1. by objective measures, a Q2 that was completely disrupted, but we made the best of it. And then Q3 has been surprisingly productive so far, and I'm hoping that continues.
That's all we have, and we're out of time.
All right, we're not that far over either, right? I was worried. 12:06. Well, thanks for hanging in there with us and for your questions. That's the most questions we've ever had. And if your question wasn't answered, you can email me directly or Tom. I believe our emails are all on our website, but mine's david@origininvestments.com. Shoot me a note and we'll answer your question. And we'll all get through this and we'll get to the other side. Be safe, everybody.